Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're going to focus on the takeaways from second quarter earnings season, and particularly focus on the regional bank group and the read-through that they might provide for the rest of the industry, particularly when it comes around liquidity and credit, concerns of which have drawn considerable scrutiny from the investment community since the spring. To tackle that is a veteran of the sell side who just told me on our pre-call that I believe this is his 100th earnings season, Terry McEvoy, Managing Director and Lead Superregional Bank Analyst at Stephens. Terry, thanks for coming on the show.
Good afternoon, Nathan. I've enjoyed listening to the Street Talk podcast series myself, and I'd say the whole bank research team at Stephens uses many of the S&P capital products. So thanks for having me here today.
Well, terrific. Well, let's start off talking about your key takeaways from the first week and a half or so of earnings. Were there any really surprises for you? We had pretty negative views, or really the buy side had pretty negative views of the group heading into this. Did anything stick out for you?
Sure. I would say this morning we went through and found that 46 of the largest 100 banks have reported second quarter earnings so far. And just from a high level, while 28% missed PPNR estimates and about a third of the companies missed bottom line earnings per share relative to consensus, there were some positive takeaways. The pressure and the miss was really focused on a decline in net interest income and the ongoing pressure on the net interest margin. But overall, I don't think there were any glaring, massive fireworks that emerged, at least through week one of earnings. On the question of surprises, when I looked at the data, I was pleased to see on a year-over-year basis for those 46 banks, earnings up about 7%, pre-tax, pre-provision net revenue up actually over 10%. And I think those positive trends really surprised me, as well as about 5% annualized loan growth. On the negative side, and I don't think this was a major surprise, the mix shift out of non-interest-bearing deposits continues to occur and accelerated to about 30% of total deposits from 33% in the prior quarter. Interest-bearing deposit costs came in higher than expected. And then lastly, I'd point out, I don't know if this is much of a surprise, but since the implementation of CECL just a few years ago, the quarter-to-quarter provisioning has been a bit difficult, but from a modeling standpoint. But I would say there was no major step up in the allowance for credit losses, with some modest reserve building of about 5 basis points on average in Q2 to account for the changes in the macroeconomic environment or outlook.
That's a really great overview right there, and I think it kind of speaks to one of the things that came a takeaway from me. I mentioned the buy side sort of negative view heading into the season, and while there's some challenges that you just highlighted, particularly the most notable of which is the mix shift in deposits, I feel like with what we had seen with regional bank stocks getting so hammered, particularly over concerns about liquidity, this feels a lot more positive than that, because it feels like a lot of the negative story and the challenges were very much built in to the names. Do you think, and we've seen kind of a melt up in valuations over the last month or so, do you think that results will help calm some of those most severe scenarios from a liquidity perspective?
I think let's start off with what the market has been telling us. Year to date, the KRE, which is the regional bank index, down, call it 20%. The NASDAQ bank index down about 15%. And bank stocks were underperforming going into, call it the SIVB news, just on the higher for longer rate environment that would put pressure on revenue and margins. But specifically to 2Q results last week and management commentary, I would say let the market speak for itself. I mean, since July 1st, the KRE is up 17%, NASDAQ bank index up just a little bit less than that, but really importantly, far outpacing the S&P 500, which is only up about 2.5%. So I think what we learned is not every deposit relationship is going to JP Morgan or the too big to fail banks. Not every office CRE loan is going to go to zero, and that there was some month-to-month stability as it relates to the deposit market, the funding market that several banks pointed out. And I think that is why that either melt up or sustainable rally, it's to be determined, has occurred in bank stocks so far in the month of July and post the earnings season.
Sure. A number of these names, it feels like they were priced as if they had severe liquidity problems, liquidity fleeting, sort of more of the panicked runs and outflows that we'd seen in March and April for the industry. And it doesn't feel like that's what you've seen across the group. I was looking, and you've seen outflows across most institutions, though it's been a little bit uneven, but median modest linked quarter declines and deposits, not something that really jives with cash rushing out of the system.
Yeah, 100%. The deposit data so far we knew would be down because you see that every week in the industry data, but there is some signs of stability relative to the industry data, particularly at some certain institutions that are really important. The deposit market remains intense. And what I've heard from bank management teams is that it's this idea of playing defense. You've got to keep your existing customers happy, but at the same time playing some offense where you need to pay out for deposits to execute on a longer-term growth strategy. The other thing I think we've all became aware of in the last 3-4 months is banks have a lot of flexibility when it comes to funding. Use of the Federal Home Loan Bank. The brokered CD market is large and it's efficient. And also many of the banks, or I would say many, a handful of banks operate digital banks within the bank themselves, whether it's as obvious as Citizens Access, which is part of Citizens Bank, or Brilliant Bank, which is part of Equity Bank in Wichita, Kansas. So there's a lot of avenues to grow and support your funding base, and banks have successfully utilized those funding sources to provide liquidity to fund their day-to-day operations and to fund loan growth.
One of the things I've been thinking about, and you just spoke to this some, is that you really saw a lot of institutions. Some really needed the cash and were feeling more pressure, but it felt to me like beyond the pressure of higher rates that you saw a lot of people act almost out of abundance of caution. Let's shore up our balance sheet. Let's pull all these different levers you just outlined to make sure that we have it and we're going to show strength as a result. And to me, I've kind of wondered if that really has woken up depositors, and the idea that you definitely had some that were aggressive, that were more focused on rates, but now that you've had to go out there and sort of knock on doors and say, okay, we're coming at you, we're gonna try to retain you, does that accelerate the pressure on deposit costs now? Have we woken a sleeping giant, or do you not subscribe to that theory? Do you think that this was more just normal course that we were going to see outside of the actions and that we saw banks take in March and April in the aftermath of failures?
Yeah, there's no denying that the events in March and April heightened the level of sensitivity around FDIC insurance and what is my bank paying me for my deposit today. A year ago, if we were having this conversation, we probably would have said deposit betas this cycle land up maybe in the mid-30s range, whereas the outlook from management teams last week on average is in the low 50s. And I should point out that the average cycle-to-date beta so far, at least for the superregional banks that have reported, is now already at 41%. So a combination of the events earlier this year combined with the Fed continuing to raise market interest rates, and we'll probably get another one this week, has all come together to put pressure on deposit prices and costs. And like I said, just raise the awareness of what banks are paying for deposits every day. It's hard to drive into work or click on a website without getting an ad for a 5% plus short-term deposit product that is very attractive. And I think on the commercial side, it's equally as competitive. And we'll see what the Fed does this week and what they'll do next year. And the market has said higher for longer will be bad for bank valuations and bank earnings. And if the forward curve is correct and short-term interest rates come down next year, we could see some relief on deposit costs and funding costs, which would be welcome news for the banks that have reported so far and for the sector overall.
Sure. And I think of that in sort of two pieces, talking about banks out there, call it the 5% number. One, on the positive side, that should attract new funding, or at least retain it, you would think. Whereas if you wind back in 22, when we saw outflows across the industry, banks were the gap between what banks were paying and what you get in the money market and treasury market was massive, and that spread is now narrowing. Do you think that helps mitigate outflows or at least slow them in the second half of the year as banks continue to catch up? I mean, there's a cost associated with that, obviously, but are you still expecting greater outflows from here, or do you think it actually slows down?
I think the outflows will continue to occur for a number of reasons, but the pace at which they flow between smaller banks potentially and larger too big to fail banks or other options that are out there in terms of places for individuals and businesses to hold their cash, that will slow as well. So the deposit market is shrinking. Banks have adapted to that, are managing their balance sheets around that trend, and that going forward, that trend will continue at a slower pace, making it, I hate to say easier, but less of a challenge to find liquidity, support your liquidity, all of which is a positive for bank earnings, bank stability, balance sheet stability, and hopefully growing shareholder value for publicly traded banks.
And that comes at a cost, and that likely means some margin pressure, which we saw kind of across the board. Two questions there on margin pressure. Do you think that we need to see rates come down for margins to hit a trough, for a recent trough? I know we were lower, call it a year and a half ago, but for that pressure to subside? Or do you think that there could be some stabilization here, even if we just get to peak terminal rates? What have you assumed, and when you look at your coverage universe? I know it's different for each institution.
Sure. For the banks that have reported so far this season, the net interest margin was down 13 basis points on average, though that's less than the 17 basis points in the first quarter. So the rate of compression is slowing. Assuming the Fed hikes one last time this week, which is based on our assessment and outlook, we think net interest income bottoms later this year and shows stability in 2024. And within that underlying assumption is deposit costs will continue to go up 2 to 3 quarters after the last Fed rate hike, which would suggest kind of some true margin stability in the first part of next year as the higher rate environment is fully incorporated into the funding base.
Right. And so you don't even need necessarily a pivot for that pressure to kind of subside, which I think is important. We talked earlier, or you talked earlier, about credit and around provisioning, and I want to change to that and talk a little bit about what we heard from Q2 results around credit. And you talked about reserves coming up. That seems very reasonable that you would see that, given the way CECL works, that it's supposed to be more forward-looking, and the environment is pretty uncertain, and there's plenty of negative scenarios out there. But to me, I didn't feel like we saw reserves come up in a very material way, and we didn't really see any blips in credit aside from one-off credits driving performance, modest deterioration in a few institutions. What was your read through?
I think what we saw and heard last week was the credit cycle is normalizing. There will be a slow and steady increase in credit costs in general, overall credit quality statistics as we move to more longer term trends, and that is not going to occur overnight, which were some of the fears, at least in the marketplace earlier this year. The bank data that was reported, net charge-offs of 15 basis points in the second quarter, a 3 basis point increase in the non-performing asset ratio, so nothing jumping off the page in terms of signs of concern. And getting back to CECL, that tells us the banker's view of the lifetime losses of their loan portfolio. And what these banks are saying is that those potential lifetime losses are modestly higher, very much consistent with where expectations have been all year with the banking industry and the outlook for credit trends.
Right. And that's very different from, okay, we've got a serious problem here, and perhaps that's one of the reasons why we've seen the group rally from the levels that we have, because they were trading as if that they had a significant hole in their balance sheet. I heard the normalization comment from a lot. We also saw banks make very specific disclosures around reserves related to office, and I felt like that those reserves were pretty high, but that's not necessarily a bad thing if you're worried about it. They had the money to do it. There wasn't really anything else from my experience in seeing the names, though, that really stood out. Is that, to your point, just about normalization and credit, the consumer holding up. Did bank management teams, in your mind, put anything out there that looks beyond normalization, or maybe said differently, closer to recessionary?
No, I think the disclosures that I would point out would be at Citizens Bank, where they have an 8% allowance for their general office portfolio. And if you look at the assumptions behind that 8%, they're pretty aggressive. It's peak to trough decline in value of 67%, a 50% average loss severity, and default of 16 to 18%. So even within that specific portfolio that, again, this quarter received a lot of attention from investors, the reserves in place, or at least those that have been disclosed, seem to incorporate a very dire and stressed scenario that is even worse than the losses experienced during the great financial crisis. Beyond that, there are several pockets of weakness that banks highlighted and, again, have properly reserved for. Senior housing, has been one. Certain consumer discretionary goods has been another. But I think it's really important to point out that regional banks have reduced their exposure to the toxic assets that triggered the significant losses during the great financial crisis. They're out of construction and land development loans largely. They de-risk the consumer portfolio. So I think as this normalization process continues, it will not look like anything that we saw in the financial crisis, unless interest rates move significantly higher. But as of today, I think banks have done a very good job disclosing the risk, talking about the reserves, and they could probably even do a better job patting themselves on the back for the de-risking that they've done over the last 13, 14 years that should result in a more stable credit losses through the cycle.
Certainly, and to some of the disclosures you just talked about, I don't remember seeing anything like that in 06, 07 with the bad actors. They were more screaming, "There's nothing to see here," whereas it seems like these management teams are at least trying to meet the concern with greater transparency and show why they feel greater comfort.
100%. I don't want to drink the Kool-Aid and go back to the view that home prices have never declined, so they never will decline. I think we learned a lesson there, and we always, as an analyst, we get paid to look ahead for where the next area of stress could be, and there will be some. But I feel like those categories today have been identified. There will be more to come, and we need to get ahead of those, and banks will do so as well to sell those portfolios. We've seen portfolio sales at some of the larger banks to de-risk the balance sheet. But there are areas that we will need to focus on, and there will be some negative surprises. But as of today, coming out of second quarter earnings, like I said, the path to normalization appears to be consistent, is believable, and will allow banks to continue to remain profitable and build capital organically.
Do you think that's reflected in valuations right now? The idea of normalized credit losses, not severely high credit losses, and lower margins, the two big pieces we're talking about here, both were expected, but do you think the trend line that we've got and you feel like you're seeing that's reflected with the rebound, or are they still discounted relative to the fundamentals as you see them today?
Yeah, earlier in the year, I would say yes, the valuation reflects a very challenging rate environment and higher than expected credit losses. But after the move this month in particular, I think that we need to be a bit more selective, and that, just to put some numbers behind that, the updated PE ratio for 2024 for the superregional banks is 10 times earnings. Starting the year was 8 times earnings. So estimates have come down more than stock prices to the fact that PEs are 10 times earnings and maybe closer to the middle part of their longer term range. So I think the market is priced in properly, the impact of rates and margins, but the normalization of credit, should that happen faster than expected, does present a risk at these multiples, again, given the move in stock prices that have occurred, particularly over the last 2-3 weeks.
Quickly in closing, is there anybody that, one of the things that we've heard consistently over the last few months is that the group's been painted with a broad brush. Do you think there's anybody who's still really misunderstood, either to potential downside or upside, that is being kind of unfairly treated in your mind among your coverage universe?
Sure. I this wasn't on purpose, but mentioned Citizens Financial CFG as a bank that has strong disclosures as it relates to their reserving and the underlying portfolio characteristics. The regulatory capital, excluding the AOCI, is one of the highest in the peer group. And it does have, I think, a differentiated model on both the lending side and deposit gathering side through some unique businesses that will provide incremental growth. But yet the stock still trades at just a slight premium to tangible book value and at a single-digit PE multiple, which to me suggested the stock remains undervalued despite the positive move so far this month.
Great. Well, I think that's a great takeaway. Focus on Citizens listeners. Terry, thank you for putting light on the Q2 results and what takeaways we all need to have. We appreciate you coming on.
You're welcome, Nathan. Enjoyed it. Have a good day.